Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery. Let's get you up to speed on today's gains because we're looking at some buying action as Wall Street attempts a year-end rally of the Dow up 365 points right now. S&P up nearly 2%. But look at the Nasdaq. Nasdaq by far the leader in today's action, up just about 2.5% today. And Jared, when you take a look at some of the leadership, sector-wise at least, communication services and technology, really the outperformers this afternoon.
Definitely, Shauna, and I think investors have been wondering, where is this Santa Claus rally? We're about midway through, so nice to see some gains today, although we're roughly break even when you count the days back to Friday when that officially began. But let's keep it with the Nasdaq here. Here is what's happened today. So this is the best day since November. In fact, all the indices are having their best day since November today so far. But interesting thing, we had our record high for the Nasdaq on the very first trading day of the year, and only yesterday we saw the lowest point of the year, at least in terms of the settlement. So that doesn't happen very often. Just thought I'd point that out. But we are in the green today. And if you take a look at the sector action, it's really the tech sector, and that's XLK specifically, but also communication services. That's XLC and XLY, which is consumer discretionary. Amazon's in there. Tech really dominating here. So these unloved mega cap sectors that have gotten really hit this month. Let me just take a 1 month view here, and you can see XLY, consumer discretionary, the worst off. Tech, XLK not doing that much better itself. When you take all this into consideration, not a bad day. Now here's the Nasdaq 100, a standout Tesla. We're going to be talking about this. Tesla's up 6%, snapping its 7-day winning streak unless something happens over the next hour. Apple also up 3%, coming off a 52-week low. So really important to track these gains here, Shauna.
Certainly is. All right, Jared, let's get everyone up to speed on Southwest because that's a big story that we have been following. Shares moving to the upside today. You can look at gains of nearly 4%. Now the gains coming despite public scrutiny over thousands of flight cancellations. The airline releasing a statement earlier today, writing, quote, "We plan to return to normal operations with minimal disruptions on Friday, December 30th. That's tomorrow. Now the airline has canceled over 2,300 flights today alone. That's over half of its schedule. As of right now, though, only 39 flights have been canceled tomorrow. So far, 0 on Saturday. That's according to the latest numbers from FlightAware. Now, despite these somewhat positive signs for Southwest, the backlog of cancellations, piles of bags at baggage claims, and also thousands of angry customers awaiting refunds will likely prove to be a huge challenge here for CEO Bob Jordan.
Now let's turn and get you up to speed on mortgage rates. The average 30-year fixed mortgage rate rising to 6.42% from 6.27%. It's the first increase after 6 weeks of declines. Now the 30-year is nearly double what it was a year ago, and the 15-year rate is roughly unchanged from last week. High rates have been deterring buyers. Only yesterday, we learned pending home sales, they slid 4% in November and down 37.8% year over year.
All right, well, let's get back to the broader gains that we're seeing in the market. Again, the Dow up 370 points. Nasdaq, though, leading the way up just about 2.5%. We want to bring in Youngyu Ma, BMO Wealth Management, U.S. Chief Investment Strategist. Youngyu, it's great to see you again. So today's rally, I guess a bit of good news here as we round out what has certainly been a very challenging year here for the markets. What does this signal to you in terms of what investors should expect as we look ahead to 2023?
Yeah, hi, Shauna. Thanks for having me again. It is nice to have a bit of a relief rally toward the end of the year. It's been a tough year, obviously. I wouldn't read too much into today's action. There is a lot of pessimism out there. So I think that does set up the market for sort of a snapback rally at any given time. But we are in the heart of, or approaching the heart of the time when we're going to get earnings warnings. And so that's going to cause an overhang in the markets until we get some more clarity and until the market can see some stabilization ahead.
Let me ask you about that because you noted something, I'm reading your notes right here, something that's happened the past 2 quarters that centers around earnings season. I'm always interested in seasonality plays here.
Yeah, it's been interesting. Actually, the past 2 quarters, we've seen the market carve out a short-term bottom right about 2 weeks after the quarter end. So really right into the heart of those earnings warnings, the market had been declining and then stabilized as the market sort of sniffed out that the actual earnings might not be that bad. So we think there's a high chance that this quarter could be a repeat of that same scenario where we struggle for a few more weeks, but as we get closer and closer to the actual earnings reporting, things actually don't seem so bad. So that's a pattern to look forward to that's played out the last couple quarters.
So Young, do you, I guess, look at that type of bounce, potential bounce in the markets as a buying opportunity here for investors?
Well, we do think sell-offs here are going to be buying opportunities, and that is based on our expectation of a soft landing in 2023. We do think the labor market will remain stable. We think that inflation is going to continue to come down. Consumers will see real wage gains, and corporations are not going to cut back all that much if spending is still pretty healthy in the economy. We just think that recalibration process is going to take a couple quarters to play out. So we do think that to the extent that we see some downturns in the equity markets over the next few months, that those are probably going to be buying opportunities.
All right, you mentioned soft landing, so we got to talk about the Fed. Big meeting, end of January, early February, I believe. What are you expecting?
Well, the Fed has definitely signaled a difficult path ahead. We actually think the Fed is overly hawkish and overly negative in some of its projections in terms of higher inflation, slower growth, higher unemployment. We don't think that's actually going to come to pass in terms of unemployment shooting up as much as the Fed is expecting. So in the coming meeting, we think the Fed will probably soften its tone a little bit if inflation continues to come down as it has been. The data has actually been reasonably good for inflation. And if we see that the labor market, at least at the edges, is softening a bit, which we are seeing, still healthy labor market, but that's softening around the edges.
So Young, then how many more hikes do you think are likely on the table then and before the Fed maybe pauses?
Maybe another 0.5%. We think that's probably par for the course. Perhaps a 0.25% the next meeting, maybe 0.5%. But overall, we think the Fed is going to pause right around 5% in terms of the Fed funds rate and hold it there for quite some time. Could it be another 0.5%? Could it be another 0.75% on the upside if we get some negative inflation data? Both of those are possible, but right around 5% is where we see somewhat of a steady state for 2023.
And when we look inside the market, what are you looking at specifically in terms of sectors, styles, any positions that you're interested or areas of the market you're interested in the new year?
Yeah, Jared, there definitely are. We actually think much of the plays that revolve around infrastructure have a lot of runway to them and a lot of legs. And that, of course, spans a few different sectors, some areas of industrials, some areas of materials. But we have a lot of money that's going to flow into the economy from the Infrastructure Act, from the CHIPS Act, from the Inflation Reduction Act. And that's going to create, there are hundreds of billions of dollars of spending that are going to flow through the economy over the next few years. And we think that provides a nice runway for infrastructure. We also think biotech is probably likely to have a good year. There have been a lot of major platform developments we think are going to continue to play out in the biotech sector. So we think that's actually an area of outperformance for 2023. And I'd say a third area to pay attention to overall is just value. We think that value over growth has a long runway to it as well. So low PE multiples, stable businesses, returning cash flow, or buying back shares, increasing their dividends, those areas of value that really look more stable, we think have a nice trajectory to them as well.
Young, you mentioned earnings warnings. We certainly have seen the estimates lowered for 2023. When do you expect earnings to then stabilize potentially?
We do expect them to stabilize, and that's part of our soft landing thesis. We think this recalibration probably has another quarter or two to go in terms of seeing pretty meaningful earnings cuts over this coming quarter and also the second quarter. But into the back half of the year, we think those earnings will stabilize, and we think the market will probably catch wind of that early in 2023. So we're expecting choppiness in the near term, but we expect our expectation of those stable earnings should filter through into a stable market in the coming months.
Slightly optimistic tone. I like it. Getting ready for the new year here. Young-Yu Ma, BMO Wealth Management, U.S. Chief Investment Strategist. Thank you for that today. All right, we're just getting started here on Yahoo Finance Live. Coming up, layoffs are coming to Goldman Sachs. We're going to tell you where in the bank there are going to be cuts, plus economic headwinds battered big tech in 2022. But could the sector be poised for a big year in 2023? And Yahoo Finance readers, you reveal what you're expecting in the new year. Don't go anywhere.
Goldman Sachs CEO David Solomon warning to staffers that job cuts could be coming next month or are coming next month. Solomon making the announcement in a memo to staff. Yahoo Finance has learned that the cuts could be up to 8% of Goldman's workforce. Our next guest got the initial scoop on this story, and she joins us now. We want to bring in Liz Hoffman, Semaphor's business and finance editor. Liz, it's great to see you again. So let's talk about these cuts, because as many as 4,000 jobs could be on the line. What can you tell us just in terms of the details of the cuts and what divisions they're likely to come from?
So it's going to be across the firm. You'll see them especially deeply in consumer banking. Goldman has spent the last 5 or 6 years trying to become a major Main Street banking player, and it really hasn't worked, and they're sort of dialing back a lot of that ambition. Part of this is just that the headcount sort of exploded over the last, 3 years. They've added 10 or 11,000 people. Some of that is, laying off the annual layoffs. During 2020, it was fairly insensitive to be firing people. Last year, everyone on Wall Street was making so much money they didn't have to. So a little bit of just kind of yearly housekeeping. But this is, the deepest cuts I can ever remember at Goldman. I've been covering the firm on and off for almost 10 years. They didn't even cut this deeply during the financial crisis. So this is a serious round of layoffs.
How much of a black eye is this for the CEO, David Solomon? Because you compare him to Lloyd Blankfein, the previous CEO, who almost seemed untouchable. This is a relatively new venture. Is this an admission of failure for the bank? Was it simply a case of bad timing? What's your view?
I would start by noting that Lloyd ran a very different firm than David does, very different Wall Street, very different environment. But yeah, this is a black eye. I mean, look, they were recommitted to this strategy, not just 6 or 8 months ago. So, what I've been hearing in the last couple of weeks is that the numbers that are being floated, individually for layoffs keep getting bigger, which suggests to me that not only is there a hole, but that they're still getting their arms around how big it is. This is a real black eye, I think, for the administration there. And they're going to have to work hard, I think, to win back the trust of, certainly senior partners. Goldman, as you'll remember, has a partnership, which is, sort of in name only, but is this unique power center that CEOs at the firm do have to contend with in a way that, the CEO, Jamie Dimon, doesn't. And they're about as riled up as I've ever seen them.
And Liz, going off of that, just in terms of some of the questions that you think Solomon and the top executives at Goldman Sachs are going to face just about his strategic vision for the firm, given what's happened to Marcus over the last couple of years.
So the next 6 or 8 weeks are going to be incredibly fraught for David. He's going to start the new year with layoffs, serious layoffs. He's going to announce fourth quarter earnings, annual earnings, which from a top line perspective will be very good, $48, $49 billion. They're looking at their second best ever year of revenue. But you're going to see huge losses in consumer. I'm told also very sizable losses in asset management that are really going to bring down the P&L for the year. So you're going to have earnings that aren't really going to impress anybody from a bottom line perspective. The next day, they're going to hand out bonuses internally that are going to be largely disappointing. Then David is going to go and host a partner retreat in Miami, where he's going to have to defend and lay out his go-forward plan to the 450 or so partners at the firm. And then he's going to come back to New York and do an all-day investor presentation where he's going to have to make the same, sort of promises and commitments to shareholders and say, listen, I know I was up here 6 months ago, a year ago, 2 years ago, telling you that the plan we had was the right one. Turns out it isn't. So, look, David is a pretty deft manager. He's I think, well-respected by shareholders. He's certainly tilted the balance of sort of the equities at Goldman more towards public stockholders, since he took over than, from internal constituencies. So he has a little bit of goodwill there, but, this is a tightrope he's got to walk very carefully over the next 2 months.
Could you compare Goldman Sachs to Morgan Stanley for us? I'm looking at the returns there. It looks like Goldman Sachs is down 10% for the year. Morgan Stanley actually down a little bit more. But you could make the case that Morgan Stanley is trading above Goldman Sachs in terms of its book value. There are various metrics there. The reason I choose Morgan Stanley, of course, is because Goldman Sachs in a very similar situation. Both of them converted to bank holding companies over the global financial crisis. They didn't have that retail depositor base. Morgan Stanley went a different direction. Both were buying brokered deposits at one point. How have their paths diverged, and is Morgan Stanley now being seen as perhaps a winner?
Absolutely. I mean, these are the two old legacy investment banks. They do still see each other as really fierce rivals in a lot of their businesses. but they almost don't bear any resemblance anymore. Certainly both have big trading franchises and big merger franchises. But to your point, and I don't know where the numbers are today, but Morgan Stanley trades at 1.6, 1.7 times its book value. Goldman is at about 1.1 or 1.2. And that really reflects investors' comfort level with Morgan Stanley. Morgan Stanley has gotten very big into these very safe, fee-based businesses. When James Gorman took over after the financial crisis, he said, the future is money management, right? You manage trillions of dollars. It's very sticky money, and you take 50, 75, 100 basis points right off the top every year, and they've got $4 or $5 billion of profit when they turn on the lights on January 1st in that business. So, I wrote a story for the Wall Street Journal about 5 or 6 years ago, looking at the legacy of that conversion, as you noted, to the bank holding company status, which really saved those two firms in 2008, gave them access to very cheap government loans. And I think I said, they've both come to Main Street, but they're walking down different sides of the street. And, you're really seeing now which route, shareholders prefer.
And Liz, let's talk about what this all signals for 2023, because right now we have banks slashing headcount. Goldman by far the most, at least up until this point, but they're far from the only bank that has signaled or has said that they are going to be laying off workers or instituting a hiring freeze. And then, of course, we also had the reports that bonuses could be slashed 30 to 40% for this year. What do you think this tells us about the year ahead for Wall Street?
Well, I think it's important to put bonuses in the perspective of revenue, right? So you're going to see, bonuses come down 20, 30, 40% across different businesses. Most of these firms allocate bonuses based on, 1, how did the firm do? 2, how did your division do? And 3, how did you do? And so it's some waterfall, and a lot of these firms had terrific years. And so, you'll see it a little more in line with revenue. I would expect the cuts to be deeper at Goldman. We had reported that the partner bonus pool, which is entirely discretionary, set by David Solomon and his top deputies, is down 50% this year. And it's important to note that, the last time I think, when I talked to people that they were sort of this dyspeptic was 2008, but that was an industry problem, right? It was across the street. And frankly, Goldman weathered it better than almost anybody. This is not that. This is a little bit of an own goal. And so I think, there's only so much money to go around when you have these deep losses and these growth businesses. And David has made the decision to try to share a little more of that with public stockholders and get the return on equity up, with the thinking that if the stock price goes up, it's good for everybody. But getting it there and dialing those levers up and down at the same time is very tricky.
It's certainly going to be at least challenging first half of the year for Wall Street. Liz Hoffman, as always, thanks so much for joining us here on Yahoo Finance today. Well, coming up, tech giants like Alphabet, Amazon, Tesla have all seen their stocks get pretty beaten up this year. But our next guest saying that there could be opportunities there for long-term investors. Will tell us why next. Big tech may be happy to see 2022 go, but after layoffs, regulatory scrutiny, and crashing stock prices, what lies ahead for the industry? Yahoo Finance's Ali Garfinkel joining us now with that look ahead. And Ali, guess what might 2023 look like?
You know, Shauna, I think it's safe to say that a lot of what we've seen in 2022 is set to bleed into 2023. For instance, we're likely to see more layoffs, for example, and those hiring freezes that went into place a while ago at companies like, say, Google or Amazon, those will continue into next year. Companies are still contending with inflation, softened consumer demand, and frankly, a digital ad slowdown that has slammed even some of the biggest names in the business, like, for example, Meta, which laid off 10,000 employees, I believe 13% of its corporate workforce just a couple months ago. So there's that. I expect to see that continue. Another thing I actually also expect to see continuing is Washington. Washington stepped up its efforts to regulate big tech this year, and I don't think we're expecting to see that stop, right? For example, in the process right now, we have the FTC's attempts to block Microsoft's acquisition of Activision Blizzard, which is valued at $69 billion, and Meta's acquisition of VR company Within. There's also on top of all this, right, there's the ongoing battle over Section 230, and Google's fighting a lawsuit related to its search dominance. So there's a lot going on the Washington front. Expect to see things like layoffs and hiring freezes continue, but there is a kicker. And a lot of experts I talk to actually say that the second half of next year could bring better news for big tech. I'd love to use M&A as a case study. I used to be an M&A reporter, so it's my natural go-to. Look for a reset in tech M&A, for example, especially in Q3 and Q4. Private market deals are going to recover before the big public market deals, but we are going to see notable consolidation, even from companies like Amazon or Microsoft as the year goes on, in all likelihood. So I think EY TMT leader Carl Chang summed it up best. He said he's going into this year looking at M&A and big tech overall cautiously optimistic. And I would say that's the attitude we're bringing in right now.
Ali, lots of people banking on that second half of 2023 turnaround. We'll have to see if it comes. Thank you for that report. Ali Garfinkel. A grim year for tech, no doubt, but our next guest thinks greener pastures lie ahead. Joining us now is Constellation Research Principal Analyst and Founder Ray Wang. Ray, thank you for joining us here. Let's start with some of your calls on the mega caps because they're up today. We're having a nice day, but they've been absolutely brutally sold this year. Amazon actually exceeding to the downside its pandemic low from 2020. Your thoughts on some of the giants here?
You're right. We've been hammered. It's been a bad year. Ali set the stage correctly, right? The era of easy money is over. Inverted yield curves are real. It's the worst IPO year ever. However, I actually think it's going to be a better year in 2023, and that's why these calls, right? For example, right, let's take some of the Matana stocks that we talk about. Apple was in a good position in the long run. They've got great services. China's going to reopen. The economy will get better probably in the second half. Right? The cloud vendors are doing great, right? You think about what's going on with Alphabet, right? And Amazon and Microsoft. These companies have amazing residuals that are in cloud, right? These are 3 to 5 year deals in the cloud for Fortune 500 companies that are in the hundreds of millions of dollars, right? These are also pretty strong. And then, of course, right, we're looking at Tesla. Tesla's been battered so much. To a point where even Cathie Wood jumped in with a $2 million purchase today. But it's more than just a car company. It's about electrification. It's about the future of autonomous vehicles and driving. It's about energy management. There are other business aspects of Tesla that are there. And then, of course, we love the enterprise tech stocks. If you look at an Adobe or ServiceNow, or if you look at Workday, and if you look at these companies, they're doing really well going forward because they've got also long-term enterprise tech contracts. And so the theme really is these companies are still growing. They're profitable. Their earnings are growing in the 20 to 30% range. Their profitability, especially for SaaS and cloud companies, can be as high as 90%. They're really strong buys.
Right, let's talk about Tesla because today's jump, yes, obviously it's an outperformer here. We're looking at the best day since July, but certainly has been under a tremendous amount of pressure for 2022. When you take into account some of those challenges that lie ahead, you have the Twitter distraction, you have demand worries, just in terms of some of the incentives, the price reductions that they're offering U.S. customers before the end of the year. Also, some concern about what's happening with its plant in Shanghai, production there. I guess, how long do you see some of those risks lasting until we start to see this momentum really start to shift at Tesla?
Shauna, you're right. It's the worst month, worst quarter, worst year ever for Tesla stock. And that also means when you buy low, sell high, you have a great opportunity. For Tesla, it's probably 6 months out. Here's why. The incentives are gone on the US side that you're talking about. The incentives in China end at the end of this month. But China is coming back. It's the world's largest EV market. They're placed well there with their Shanghai plant. And then, of course, Tesla has about a 3-year lead on everybody else right now. And if you look at sales, people still want Teslas over other EVs, and it's a lot to do with the charging network. If you get range anxiety, you're going to want to be next to a supercharger and be able to charge, and that isn't as easy for some of the other EV manufacturers.
Ray, I want to talk about semiconductors and direct everybody's attention to the Wi-Fi Interactive, where I have our semiconductor heat map covering the month to date. So December, not looking very good, except for Broadcom. That's the green space at the top, up 1%. But for the most part, lots of red there. And of course, chips are a very cyclical sector. I would point out that quarter to date, we're still holding on to some nice gains. So it looks like October, November were green months. But just in general, how is the cyclicality of the chip sector playing out? And what do you expect for the new year?
Yeah, so what we're seeing is a chip glut on DRAM chips and memory chips, but we're also seeing some opportunities for companies like Broadcom, which is diversified into software. They have the VMware deal that's been there. They've done a good job with some of the other acquisitions in terms of building a software empire. And then, of course, TSMC. They've got the $40 billion investment in 2 plants in the US. They're about to kick off their 3-nanometer chips, and that's going to be a game changer in the marketplace. And so there's still a lot of goodness on the chip side, but stay out of the DRAM and the memory side.
Yeah, and right to that point here, because there was a story in the Journal earlier this week talking about the chip glut, and that a lot of that had to do with the fact that consumers are shifting their buying habits. They're simply not spending or buying as many consumer electronics as they had been over the past couple of years. How do you see the overall landscape in the midst of that weakening demand?
Well, the weakening demand on the consumer chip set is real at the moment. However, the experiences that are going to power the future are all in the cloud and all in the internet. And by doing that, you're going to need more data centers. So the demand on data centers is still going to be huge. And if we do get to some of the metaverse aspirations that people believe we're going to head towards, right? Or if we get to the continued adoption of just even the basic cloud and the levels of cloud adoption, there's still a huge demand for chips and compute power. And that's why there's an advantage there. And of course, with AI growing, you're going to see more and more use of chips.
All right, we're going to have to leave it there. Lots of great information, Ray Wang. Thank you. Coming up, Starbucks is shaking up its reward program, and some customers may not be happy with it. Stay tuned to find out why. Time for a triple play. 3 stocks we're watching in the final 30 minutes of trading: Tesla, Netflix, and Starbucks. My triple play is, drumroll, Tesla. Don't talk about it enough. All EV manufacturers, really, because this is about today. Tesla snapping its 7-day losing streak, but the news concerns all EV makers. The Treasury Department just published its final criteria for the $7,500 electric vehicle tax credit going forward, going into effect in the new year. The final guidance, it's not going to come out till March, but interim rules will let new car buyers cash in now on the stimulus provided by the Inflation Reduction Act for electric vehicles. Critically, the vehicle must have been assembled in North America, a stipulation of the law. Now, looking at our heat map on the Wi-Fi Interactive here, looking at a lot of green, but I'm going to show you something. Here's the month to date. That's going to be an ugly picture here. You can see Tesla taking it on the chin, down 37%, but really nice to see some incremental movement. I'm going to change this back to an intraday view in terms of Ford and GM, so kind of lifting the entire space. And by the way, all tech stocks up here today.
Yeah, Jared, well, I think people just want clarity on when they're going to be able to get that tax reduction, right? When you see the prices that keep hiking. We know that Ford's put up the price on the F-150 Lightning a couple times now, and people are really counting on that reduction when it comes to taxes to keep those EVs affordable and back to a normal price. Obviously, that's what people are hoping for when it comes to EVs, right? And saving some money when it comes to gas, and also saving some money with the tax benefits. My play today is Netflix. You can see shares popping today on an upgrade from CFRA. Shares up just over 5% now. The firm moving off the sidelines here, upgrading its sell rating to a buy rating, and a new price target set at $310. Analyst Kenneth Leon noting that it will be difficult for competitors to catch Netflix, one of the few profitable streaming providers. Leon also highlights Netflix's ad-supported tier and the company's further emphasis on limited password sharing that I think we're going to see in 2023. Now, Shauna, really this comes counter to what we've seen from some other commentary when we hear that the ad revenue model was not the most popular option in November. Also, you've heard analysts kind of call for Netflix's shrinking point out, I should say, Netflix's shrinking subscribers this year. It's been an interesting year for the stock, right? You see the stock down about over 50% on the year, but it's up 60% in the last 6 months. As they've started to launch this ad tier, it seems like 2023 is going to be an interesting year for Netflix to sort of see what happens, right? Is this upturn going to continue and people sort of come around to this ad tier, or does it not quite come to fruition?
Yeah, exactly. And I think it's interesting here when in terms of the timing of this call from CFRA, because we have gotten those reports that the ad tier hasn't been, I guess, as successful as maybe Netflix had initially been hoping, but it's only been a month. And I think we really need to put that in perspective as well. I haven't seen a lot of marketing for this ad tier. I don't know if it's because I already have Netflix and I pay for one of the more expensive subscriptions, so maybe they don't exactly want me to downgrade. But the big question with the ad tier going forward is how many new subscribers they're going to be able to attract to that program, and also if they're going to be able to keep many of the subscribers that they currently have paying for the more expensive tiers. I think that's going to be critical, that we don't see a huge chunk of subscribers trading down, although some analysts aren't necessarily too concerned about that. I also thought it was interesting in Ken's note here, he talked about that he doesn't think Netflix needs a major sports event or sponsor, and that carries a risk of being a, quote, big loss leader. So we talk about Netflix not really getting into sports when so many of its competitors are doing so. I don't know, maybe it's a smart move for
One
Netflix.
way for Netflix to save money, right?
It is.
They're not spending the billions of dollars.
Billions and billions of dollars, certainly not a cheap thing to go after. All right, let's talk about my pick today, and that is Starbucks. The company is making changes to its rewards program. Some customers might not be happy because it will be tougher to score freebies with stars. Those are the points. So under the new program, let's talk about it. Members will need 100 stars to get a free hot coffee, bakery item, packaged snack, or a plastic to-go cup. That's up from 50 stars, but there is a bit of good news in this. An iced coffee drinker is going to be very happy because iced coffees and tea are now included in that 100-star reward. The next year is 200 stars. That's going to get you a latte, a frappuccino, any hot breakfast item. 300, it's going to get you packaged salad, lunch sandwich, or a protein box, as well as packaged coffee. That's down from 400 to 300. So Jared, some changes in here, the 50 to 100, the hot coffee, which I always get. I'm not too pleased that it's going to make me wait till I get 100 stars at this point, but we certainly know Iced coffee is on trend right now. A lot of people love their iced coffees.
Who doesn't
That's
with
now
this
going
weather?
to qualify.
So let me get this straight. They're basically, inflation is taking a toll on all of us. And beyond that, beyond the purchase price that you pay, they're going to reduce the value of their own rewards program by up to 50%. That if Jerome Powell did that, we'd be up in arms here, I can tell you. But
I'm up in arms about it.
It's
Okay,
after
well,
price hikes earlier this year too, Jared.
Yes.
And you're talking $1 a star, so it's $100. You're spending $100 before you get a free coffee.
the math doesn't.
Which you do quicker than you would think at Starbucks.
Unfortunately, we
given
all
the
do,
prices
right?
these
Unfortunately, we all
days.
spend the $100
Three
quicker
visits
than we
later,
think.
you're up there. Okay, I got it.
I don't know. Lots of questions, but I guess business-wise, it makes sense for Starbucks at this point. All right, well, coming up, inflation has been catching up with consumers. We're going to tell you which retailers stand to benefit after the break.
Retail sales rising 7.6% this holiday season, according to data from MasterCard, driven by discounts from large retailers like Amazon and Walmart. Joining us now to discuss if those discounts offsetting excess inventory will continue into the new year is Christine Short, Wall Street Horizon VP of Research. So Christine, holiday's not over quite yet. We still got Three Kings Day, but what's the scorecard as we sit here?
Yeah, you just brought up those MasterCard numbers that came out, 7.6%, great year-over-year growth number. But important to note that is down from last year. 2021 saw 8.5% growth. So 2022 is certainly a robust year for U.S. consumer spending, but we are starting to see that taper off. And as you pointed out, to push that glut of inventory, retailers have really had to offer deep discounts. The way the holiday shopping season, Black Friday through Cyber Monday, usually works is there are some hallmark products that are put on sale that are used to attract consumers either onto a website or into a store to buy other items that aren't necessarily on sale. But we saw a wider breadth of deep discounts. And like you pointed out, you might still have to continue into the new year because consumers are becoming much more value focused.
Yeah, Christine, what does the discounting activity look like this week? Because when I compare some of the promotional activity that I have seen online this week to years in the past, it certainly seems like the sales might even be better than they were pre-Christmas.
You're right. I'm seeing the same thing, 80% off. They're trying to push it through the new year, which, as you pointed out, I'm not sure we've necessarily seen in years prior. There hasn't been, the necessity hasn't been there, but certainly this year, consumers didn't necessarily tighten their purse strings. They were still out there shopping. We can look at JP Morgan's numbers cumulatively from Black Friday through Cyber Monday. Spending was up 17% year over year. Transaction volumes were up 14%. So all those numbers are great, but our last November retail sales number was down 0.6%. So November sales, which you would see a lot of those Black Friday, Cyber Monday sales coming in, were lower than expected. Yes, you take out autos and it was only down 0.2%, but you pointed out in your last segment, consumer electronics, some of those big ticket items, automobiles, furniture, appliances, all of those big ticket items that you were seeing consumers spend on last year, they did not come out for this year.
And Christine, heading into the holiday season, I kept hearing it's going to be more about the experience. We did see restaurant sales rise, trips, vacations, that sort. How do we stand now? How did it turn out, the goods versus services debate?
Yeah, I think that's a trend that's happening. I think it's going to continue into 2023. Certainly spending on travel, which benefits airlines, Airbnb, hotels, restaurants and bars, the experience, as you said. And that was a trend that was starting prior to COVID, of course, came to a drastic halt the last few years. But now consumers seem that they are going to, no matter what, unwilling to sacrifice any longer, willing to spend their discretionary income there. I think if we're talking 2023 outlook, in addition to experience, the other types of retailers, like you mentioned, that will benefit the discounters. So that's Walmart, Target, dollar stores. So Dollar Tree, Family Dollar, Dollar General, and then the bargain or off-price retailers. So we've seen TJ Maxx do really well, Ross Stores, Burlington Coat Factory. And that's just to show not that necessarily consumers are going to stop spending, but their behavior is changing. They are trending down. They are going to those off-price retailers. And I'm talking even high income earners. So those that would usually be targeting luxury retailers, they are pricing down to a TJ Maxx. And TJ Maxx is also holding on to their core consumers. So those middle income folks that make $50,000 or more a year, they're holding on to those people because remember, the main determinant of how people are spending is how they feel about their job situation. And unemployment is still at 3.7%. The estimates for next year are that it probably goes no higher than 4.4%. That's still considered full employment. So I think there are still a consumer out there that is spending, but they just might be shifting where they direct those dollars to.
And you were just talking about the discount retailers. TJ Maxx doing very well over the last few months, at least in terms of its stock price, but they did have some hiccups, a lot of these discounters, because of margins, planning around inflation, which had a huge rise last year. Still waiting for, maybe it has inflected, but it adds to business instability and affects the ability of businesses to plan. So how much of a headwind is that for retailers, discount and otherwise, coming into the new year?
Yeah, it's true. I mean, inflation is easing, but that's certainly been an issue as they deal with higher fuel costs, higher labor costs, higher costs of goods sold. And so margins have been squeezed. One way we've been hearing about how they plan on dealing with this is no longer, or maybe so long are the days of free shipping and free returns. Many are changing their return policies, whether that means, no longer offering both ways, free shipping and free returns, tightening that return window. We typically see a 30-day return window that might shorten, or charging restocking fee. And, as a consumer, I hate to hear that. I'm big on online purchases and returns, but as someone that follows retailers, I think it's actually a great idea, because if you think about how many ways they get hit, if they're paying shipping on both ends, and then the reprocessing fee, the labor fee to get those products ready to be shipped out again or ready to be sold again. And then you just have to also think about, certain retailers, specifically, let's say fast fashion, in 30 days, is that item even going to be resold? Does it have to be resold at a discount? So you're seeing leaders in the space such as Amazon shortening their holiday return window to January 14th. Last year, you had up until January 31st to make returns. Once someone like that does it, everyone sort of follows suit, right? So I think you're going to see a lot of retailers cut down on how generous they had been with the return policies.
All right, Christine Short, Wall Street Horizon Vice President of Research. Thanks so much for joining us this afternoon. Well, coming up next, China reopening its borders as COVID cases in the country surge, prompting concerns about new variants. We've got the latest when we come back. A number of countries are testing travelers arriving from China as COVID cases surge there. Anjali Kamlani following this for us. And Anj, what does everyone need to know in terms of these new restrictions?
Well, we know that the CDC announced yesterday that they are going to now require a negative COVID test for travelers arriving from China, and that's regardless of whether or not they're Chinese citizens or not. We also know that other countries have jumped on board in the last few days, notably Italy, that also found a handful of cases already on inbound China flights from China. We've also, and Italy for one, is actually appealing with other European nations to follow suit, because they have that open border visa situation. We've also got some Asian countries, Japan, requiring negative tests. We've got Malaysia as well, just looking at tracking. India is now requiring negative tests from all Asian, for a lot of Asian countries, including Japan, including South Korea, Singapore, Hong Kong, the like, Taiwan as well, looking to restrict or rather track some of these inbound flights. There is no word on whether or not flights will be stopped altogether. Japan notably is also restricting which airports inbound flights can come from. So a lot of movement, really, 2020 vibes here, as you can see, in terms of just placing some more focus. And all of this coming, as you mentioned, because of China's surge, but notably because there is less tracking of the cases there now with China, letting go of the zero COVID policy, as well as not tracking or not publishing cases since Sunday. So we don't have a clear view into that surge.
2020, what did you call it?
2025. That's what I've been saying.
Okay, I forgot it so quick. But let me ask you, anytime we see a rise in cases as we have infections, new infections, we do sometimes see new variants emerge. And any inklings that that's happening right now, or just any statistics as to the probability based on the exposure that might happen?
So there's always a chance. I've said this every time we've talked about variants. Anytime there's a surge, or just anytime the virus infects someone, there's a chance that it results in a new variant. And that's because when it makes copies and multiplies in your body, the DNA of it gets to have a chance to mess up, and that mess up results in a variant. So as you can see on your screen now, we know that the BQ1, BQ11 variants have been the dominant force. We're now seeing XBB start to increase its prevalence here in the US. BF7, that is another Omicron subvariant that we saw a little bit in November. That's the one that's driving the cases up in China. So it's really interesting to see it kind of have petered out, but also keep an eye on XBB, because that's another one that experts are watching right now in terms of being more transmissive. So again, Omicron subvariants, that's really the lineage that we're tracking. Experts worried about the possibility of a new variant of that same lineage, that same family from the China surge. So all eyes on there.
Yes, and we know that you're going to be tracking that for us and everybody at home here. So thank you, Anjali Kamlani. All right, coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. We are only minutes away from the closing bell, so let's break down today's market action. First, all three majors plus the Russell 2000 in the green here. Both the Nasdaq and Russell up 2.5%, Dow's up 1%, S&P 500 right in the middle up about 1.8%. And we want to take a look at the sector action for today. It's about the mega caps. So we got communication services, tech, consumer discretionary, all of those up more than 2.5%, all of them outperforming. So is real estate, by the way. Those are actually putting in returns greater than the S&P 500. 500. Staples and utilities, those defensive sectors, pulling up the rear, but obviously still in the green here. Let's take a look at some of our leaders and sentiment indices. And we have ARC, so ARC Innovation Components. Those are at the top. That's up 5%. So disruption in vogue here today, followed by cannabis, IPO, Chinese stocks, internet stocks, chip stocks, software. All of this is saying it is risk on today. But you take a look at what's happened over the last 2 days, a very different picture is emerging. And over the last 4 days, we're going to get to the Santa Claus rally in a second here, a different picture again. But back to today, we want to look at the Nasdaq 100 here. We got Apple up 2.9%. That's after hitting a 52-week low only yesterday. And Tesla up 8%, about to snap a 7-day winning streak. Shauna.
Yeah, so Jared, I guess there's a bit of good news here. I think lots of questions, though, about whether or not we could still see the Santa Claus rally, given what it could signal for the new year. What do you think? Are these gains going to hold?
We'll have to see, but here's what's happened over the last 4 days. Santa Claus rally officially began last Friday, and you can see the S&P 500 now up about 0.7%. Just want to show you a graphic we prepared. This is the Santa Claus rally gains going back to 1950, so a lot more green than red. Usually pans out for the cause in green. And just thinking a little bit about what could happen in January. When you take the 4-year presidential cycle, this is the 3rd year of it. This is the best month for the S&P 500 and the Nasdaq, and the second best month of the year for the Dow. So going to be important to monitor that. By the way, the Dow up 3.9% in January on average in this presidential cycle year, 4.1% for the S&P 500, and for the Nasdaq, it is 6.8%. So I'm going to go back to our heat maps here. Want to take a look at the travel sector before we head into the bell here, because we got a few seconds, and let's just take a look and see where we are. Looks like for the most part a lot of green. Carnival Cruise Lines is a standout here. That's up about 5%. And then Southwest, beleaguered Southwest Airlines, that's up 3%. Here's the closing bell.
Stocks ending the day with gains as Wall Street kind of attempts at a rebound rally here as we close out 2022. Dow up 345 points, S&P up just about 1.7%, Nasdaq up about 2.6% for the day. We want to bring in Michael Green. He's Simplify Asset Management Chief Strategist and Portfolio Manager. Mike, it's great to see you here. So let's talk about maybe the gains that we are looking at today, comparing that to some of the losses that we've seen over the last couple of trading days. What's your big takeaway from the action that we have seen most recently?
Well, I think part of what's happened is that simply by underperforming so much on a month-to-date basis, we were set up for a rebound. Anyone who was rebalancing a portfolio going into the end of the month that was trying to maintain an allocation between bonds and equities has just seen equities significantly underperform. And as a result, you head into the end of the month, you kind of start thinking about, how do I close out this month with my portfolio allocations as you'd expect? And the sensitivity of the market you saw today, I think, was a reaction to that.
Wanted to mention the R word here. That's recession and the possibility thereof. A lot of market indicators saying there's going to be one in 2023. You're likening this period to an analog. That's the 2000 to 2001 era. Just wondering what similarities you're seeing.
Well, the biggest one that I think we're seeing is that we have largely seen a correction on the basis of, the high-flying, richly valued names. We're not seeing any indication that markets are really trying to price in a recession per se by letting the more cyclical or more levered components of portfolio of the market, really deteriorate. Things like credit spreads, et cetera, didn't widen out this year. The underperformance largely appears tied to the Fed's actions, hiking interest rates, damaging bonds, and going back to that rebalancing characteristic I was talking about. If you were long a portfolio that, let's use math simple, let's say you're running a 60-40 bond equity portfolio or a 60-40 equity bond portfolio, at every step in the process this year, the Fed hammered the bond market through interest rates being higher and faster than was anticipated. That in turn, I think, has manifested itself in equities having to be sold. If bonds fall, you have to reduce your equity allocations. What we have not seen is any indication that markets are starting to price in a significant downturn in terms of the risks of individual companies failing or struggling to refinance, et cetera. In fact, many of the companies that are highly exposed to things like the credit markets themselves are not showing any forms of relative distress. In some ways, they've actually outperformed on a year-to-date basis.
So, Michael, what does all this mean just for asset allocation heading into the new year? Investors who have been a bit scarred by what has played out over the last 12 months, what should they be doing now to best position themselves for 2023?
So my bias is that as we head into 2023, we really want to be focusing on true quality aspects, companies that have high, stable profit margins, that have very low needs to refinance themselves or tap into the credit markets. Because the real risk that we have is that products that have historically been thought of as near cash instruments, so things like REIT funds that offer significant, cash flow characteristics or the ability to sell those funds, we're now starting to see components of gating and loss of liquidity in those vehicles. That's suggesting that cash is really becoming an issue for many asset allocators. In my conversations with institutional asset allocators, they're explicitly struggling to raise cash in this environment, as there's demand for cash coming from everything from companies trying to refinance to private equity firms increasing the equity allocations, and a lack of liquidity events throughout the year are all putting pressure on institutional and retail accounts in terms of the quantity of cash that's in the portfolio.
All right, I want to bring in now Paul Schatz, Heritage Capital President. Thank you for being here today. We had some technical difficulties. Glad you could make it. I was talking about the Santa Claus rally a little bit ago. Love seasonality plays. What can you tell us about what we might expect for the new month and year?
Always good to be with you. Sorry for the technical issues. From a seasonal basis, this is the strongest time of the year. So let's remember, Santa Claus rally started at the close last Thursday. It's the last 5 days of the year, the first 5 of the new year. That's it. There's nothing more to be said about that. Santa's limping along. Obviously, today gives him a little bump. But look, the real money's not coming back in or not going to leave the market until we get into January and earnings season. So you're still in a super favorable time of the year. You can, I've done a ton of data mining on this, and the next 7 months, I don't think have been down since the 1940s. The period from the midterms until the first half of next year, kind of the same thing. Third year of a first-term president, it's the best setup we've had just from a number standpoint. You haven't been down since Germany invaded Poland in 1939. So, and people will say, look, the fundamentals are terrible. You've got the Fed raising rates, you have inflation, you have recession coming. That's all well and good. But every time you've had a big midterm year decline, 2018, 2002, 1974, 1994, and so on and so forth, they all have led to these monster years that we're coming into. And it's because so much gets priced in the year before. And people say, well, we haven't priced in enough yet. Look, the Nasdaq's going to be down 35%-ish. So is it 2008 again or 2001 too? I don't think so. I think next year, regardless, is an up year, and it could surprise an awful lot of people. Wall Street couldn't be more negative. So when do they ever get it right en masse? They don't. So I think next year, regardless of how rough the first quarter is, we're going to be up significantly.
Well, Paul, talk about what that significantly exactly means. You're looking at the S&P at the levels today, obviously been under a tremendous amount of pressure off, 19% in 2022. When you look out into 2023 at the end of the year, where do you think we'll be?
Well, I'll say this. A lot depends on which scenario unfolds. So if the base case is we're going to have a mild recession. We have a mild recession, stocks go up 15 to 20%. No recession, 20 to 30%. A deep recession, which I think that's pretty unlikely. But even if we have a deeper recession, stocks will be up mid-single digits. Again, to me, it all boils down to, are stocks going to react negatively when we get the barrage of Q4 earnings coming out in January? And the key is, are stocks going to sell off on the bad news? Everyone knows earnings are going to be weaker, and everyone knows companies are going to pre-announce. If the market doesn't get hit by the bad pre-announcements, I will tell you that all the negative scenarios are factored in for 2023, and it's going to be a fun year. I mean, who's left to sell?
Hopefully not too many people. I hope it's a fun year too, and we got to leave it there, but really thank you two both for coming by here, Michael Green and Paul Schatz. Coming up, Yahoo Finance readers looked into their crystal balls to tell us what they're expecting in 2023. Some of their predictions may surprise you. Stay tuned. Welcome back. Yahoo Finance readers have been weighing in with their predictions for what might be in store in the new year. Senior columnist Rick Newman is here to break them all down for us. And Rick, when it comes to methodology, just give us a little background here. You told us over the break you personally read thousands of these responses.
I did, yeah. I read all of the write-in responses, actually. So maybe some of our people watching right now actually took this survey we put on the site and we put on our social media channels last week, and we said we asked for some specific predictions on where the S&P, the Nasdaq, where they're going to end at the end of 2023, what you think the inflation rate is. And then I did an open-ended question. Just tell what you think the biggest stories or the biggest surprises of 2023 will be. No prompts, so not trying to lead anybody, just blank sheet of paper, and people wrote in whatever they had to say. And I literally read all of those and then tried to condense what I thought people had to say. And you know, we have smart people in our audience. So I know this from interacting on email with most of them.
I've seen your Twitter account,
yeah,
Rick, not all
and
of them.
social media, and I'm actually often interested in what our readers and our audience and our viewers have to say, because they're out there investing. Many run businesses or are deeply involved in businesses, and they know a lot of things we don't. So I just wanted to know what was on their minds for 2023.
Well, let's start with the first one that was up there. We just had Trump potentially forming a new political party. We know Trump has announced his intention to run for 2024. His own political party, though, really points to the fact that he's losing the backing from the GOP.
Right. So, I mean, Trump should be off our radar screen at this point, I guess, except that he now is a candidate again. But of course, he's commanded our attention all along, and he wants to run again. His political power is clearly waning, but he's not going away. And what looks like is going to happen, and there is just going to be some kind of civil war within the Republican Party, either as Trump loses influence, but still tries to keep control, or, as some of our readers suggested, he tries to form a political party, in which case he might take those Trumpy Republicans with him, leaving kind of a rump Republican party behind, which I think Democrats would love, because then those two parties would split the votes of that whole side of the aisle. So something interesting is going to happen with Trump during the next 2 years, because
well, you know it.
Yeah, it looks like he's on his way out, but if he's on his way out, he's probably going to try to take the ship down with him if he sinks.
Sticking with politics, and this one is a little bit odd, Vice President Kamala Harris assumes the presidency. Now, you've read the responses, not necessarily ill will there, but maybe some kind of black swan event?
Yeah, such as President Biden dies in office. I mean, that is literally what...
he is an octogenarian.
He's 80 years old. So a lot of people said that could happen. Or he just gets sick and can't continue with the duties of the office. I mean, I didn't anticipate that one, but as I was reading through these, it popped up many times, and I don't think that's wishful thinking I'd like to think that's not wishful thinking, but it clearly reflects people are aware Biden is 80 years old, and they think his age is a real issue.
Yeah, certainly. That one did take me by surprise. On a more optimistic note, some of our readers are thinking that the war in Ukraine could end in the new year.
Right. So the question there is that wishful thinking or is that plausible? And I don't think that war is not going to end anytime soon, because Russia has given no indication at all that it plans to withdraw its forces. However, once Russia is banking on Ukraine freezing through the winter, and it's also banking on people in Europe losing patience with this war because they're paying so much for energy over the winter, because Russia's been able to jack those prices up. Once we're through the winter, I think if Ukraine's allies survive as an intact coalition throughout the winter, it gets a lot harder for Russia. Another big question, obviously, is whether Ukraine's going to keep getting Western support. If this coalition sticks together, maybe there's a chance this war could end by the end of 2023, and that would have excellent market implications. I mean, that would be a huge relief in energy markets. That's the most direct way that this war affects investors, and also the food markets, and just the instability question. And I think everybody would love it if nobody was talking about the threat of nuclear war anymore.
I would hope so.
Yeah.
And when it comes to student debt relief, not a lot of optimism on that front. So maybe no debt jubilee next year?
Yeah. So this is another one that came up. And I think the people who suggested that the Supreme Court will kill Biden's debt relief plan, I think they are actually in line with what legal analysts seem to think about the legal standing for that ground. So when Biden said he's forgiving up to $20,000 of student debt, something like $450–500 billion in total, affecting more than 40 million people. I think everybody knew there were going to be legal challenges to that. There are legal challenges to that. It got quickly to the Supreme Court. And there's at least a 50-50 chance the Supreme Court will just say Biden cannot do that by executive order. Congress could do it by passing a law. But Democrats couldn't do that when they controlled both houses of Congress, and there's no way the Republican House for the next 2 years is going to agree with that. So that if that gets shot down, it's dead.
Yeah, it certainly does not look promising, at least from this standpoint as of right now. Rick, there was also a couple of other big winners, or maybe a couple of submissions that have been submitted more than once. One of those that stuck out to us was this new trend of 3D printed homes and what that could really mean for the real estate industry.
Okay, so you guys didn't know about that either, right? So
no,
I mean,
we knew a little bit about it.
This is why I like to read through these things, because I think people are involved in these industries and they kind of know some, or they have investor ideas. Yeah, so I guess 3D. I mean, this is not something I've done a lot of research on, but I guess they're like the new version of prefabricated homes, but better and probably cheaper and more scalable. And look, I mean, one of the reasons housing is so expensive in the United States is we don't have enough of it. And there are a bunch of reasons we don't have enough of it. Zoning and permitting is one, and 3D printed houses won't solve that. But another one is builders can't get the workers. I mean, we know that's been a big problem for the last couple of years. There were huge problems for a while there with soaring costs of lumber and other commodities that push prices up. So I guess, at least in theory, 3D printed homes might help you solve the labor problem. You still got to get them permitted. You still got to get them there on trucks that have to burn diesel fuel, which is expensive. But maybe this is one way to relieve some pressure in the housing market.
Certainly cool. It really shows us where we could be headed in the future.
And we're going to go back a year from now. We're going to go back to these predictions and see how everybody did.
True. Hopefully some do. Hopefully others do not. But we will see. Again, 11 predictions for 2023. You can check it out. Rick's column on yahoofinance.com. Thanks, Rick. All right, well, coming up next, gas prices have fallen sharply over the past several months. But is that about to change? Find out next.
Pain at the pump has been a major talking point throughout 2022, but as prices have been dropping this month, are they poised to jump back in the near future? Well, according to Gas Buddy, prices in most U.S. cities could reach $4 a gallon again come springtime. So for more on this, we welcome in Patrick Dehan, Gas Buddy Head of Petroleum Analysis. Patrick, thank you for joining us here today. So what should we expect with gas prices in the near future?
Well, certainly a little bit of good news, a little bit of bad news. I think overall the good news is that Americans in the household will spend less on gasoline in 2023 than they did in 2022. But it wouldn't be a normal year without the spikes that we see in spring and prices then going back down in fall. And eventually, while we're enjoying relatively low prices now, I'm afraid that with China reopening this spring could see a nice spike, and that could bring the national average back above the $4 a gallon mark. But the good news is we're not expecting the record highs that we saw in 2022 of over the $5 a gallon level.
Yeah, Patrick, we just did a Yahoo Finance. Rick Newman was just on set talking about the predictions that our viewers wrote in. And that was one of the predictions that gas prices were going to be back above $4 a gallon because of China lifting its restrictions. Let's talk, though, about the higher prices, how long it could potentially be above $4 a gallon. Are we talking about throughout next summer?
I think that's certainly a strong possibility. It's really going to be contingent on if refineries are able to meet demand and what Americans do this summer, given the fact that prices may be lower. Do we see a big jump in demand? I think demand was struggling this summer under the weight of some of those high prices. So if a lot of Americans deferred travel, they may want to get back out on the road, given the fact that
gas prices this summer could be a little bit less. But I would say that probably between Memorial Day and Labor Day, you may see $4 a gallon for several weeks, maybe beyond that. Of course, a lot mixed into how China is looking and how much of their economy is reopening and what we see in terms of consumption from China.
Patrick, we had a number of curveballs in 2022. Euro opened up and we had suddenly found ourselves in a war embroiled in a war between Russia and Ukraine. Wondering what you're thinking about in terms of potential headwinds or stuff out of the blue in the new year.
Well, I think refining will continue to be a headwind. It was a challenge in 2022, and I think we're going to get a little bit more breathing room in terms of refining capacity. Not so much in the U.S. We're going to add about 275,000 barrels a day of capacity, thanks to ExxonMobil's refining project that's been underway for 3 years in Texas. More so, we're going to get breathing room overseas, Africa opening refineries, additional capacity in Asia, as well as the Middle East, all likely helping to create some breathing room. But there still could be the seasonal challenges related to the switch over to summer gasoline as refiners carry out that maintenance. And keep in mind, the extreme cold weather that we saw across the U.S. last week also caused a lot of refinery disruption. So that's going to be the wild card this year, as well as I think China's economy. They appear to be embracing easing the restrictions. And so there could be a level of pent-up demand in China that we saw here in the U.S. a couple of years ago, and that could be a wild card as well.
And Patrick, when it comes to higher prices in terms of areas of the country that are likely to see the highest prices, is that going to be consistent with what we saw last year when you take a look at California, obviously being one of the outliers and experiencing much higher prices than what we saw in many other parts?
Yeah, absolutely. The model last year was certainly that the coasts felt a lot more of the pain, particularly the mid-Atlantic, the Northeast areas that are reliant on more imports, and the West Coast also somewhat segmented away from the rest of the country. So both the extremes, the Northeast and the West Coast, likely to see some of those refinery challenges persist. California certainly could see the return of $5, even $6 a gallon gasoline if refinery issues are significant this year. Much of the Northeast still also relying on imports because of Russia's war in Ukraine. A lack of refining capacity in the Northeast also could point to prices that in New York, areas of New England could exceed $5 a gallon again this year.
We're just recovering here in the Northeast from a bitter cold spell, storm that passed through. Just wondering the implications that this might have had on the energy market overall, including heating, gas prices. Kind of give you the floor for the last question here.
Well, we've seen a lot of volatility in natural gas. Things have really plummeted, but there's still the possibility that if natural gas surges due to cold spells, there could be switches back over to using oil, diesel, and heating oil. So that's a huge wild card, but the Northeast is going to be very susceptible to bouts of cold weather. Keep in mind, much of the Northeast consumes heating oil. I think that's going to be a challenge this winter. Diesel and heating oil likely to remain rather expensive, comparing that to gasoline for much of the winter.
All right, Patrick Don, always great to have you of Gas Buddy. Thanks so much for joining us here this afternoon. Well, Southwest facing backlash after canceling thousands of flights around the holidays, leaving travelers and their bags stranded. Well, Southwest CEO apologizing for the mess, stating that the airline will need to upgrade its systems to make sure that this does not happen again. But new data revealing that even when Southwest isn't in a crisis, it's not the most reliable airline. Southwest ranking number 5 for most on-time North American airlines. That's according to data from aviation analytics company Cirium. Now, when you take a look at flights on time, only around 74% of the flights across the nation were on time. So who ranks number 1? Well, that would be Delta. Delta Airlines taking the title for the second year in a row. 84% of Delta flights were on time this year. Delta is followed by Alaska Airlines, United, and American. Jared, when you take a look at those numbers, much higher than what I was anticipating, given all the cancellations and the delays that we saw throughout the summer.
Well, I guess you have to consider the entire year here. So with that, Southwest finds themselves in the middle of the pack, though they're probably at the bottom of the pack when it comes to December figures. And by the way, this is a major embarrassment for Southwest to experience this kind of failure that could have been corrected with a little bit of foresight if profits weren't such a concern, maybe in previous quarters. I'm editorializing a bit. What surprised me, though, Rounding out the bottom here, Air Canada, 55%. That's a pretty bad on-time average, followed by WestJet, Allegiant Air, JetBlue, Frontier, and then you get to Southwest. Anyway, the bar is set so low with me personally. I don't know about you, Shauna, with respect to on-time delays and airport travel. I'm not looking forward to myself in a couple weeks here. But I guess the bottom line is that you got to expect these things from time to time.
You do, and especially if you live in this area, because we know they come out with the rankings. In addition to the airlines, the airports, and the airports that are relied on the most or the least reliable. 3 of the worst are routinely Newark, LaGuardia, and JFK. So if you're flying into this region, you are likely delayed more than many other travelers are experiencing across the country. So I think you and I are pretty used to those airline delays by now. All right, well, coming up, we will talk to a CEO of a company who's using artificial intelligence to help modernize manufacturing processes. Will join us next. The pandemic shed light on the lack of pharmaceutical manufacturing in the U.S. One company trying to change that is Quartic AI, and they're doing it by using data and artificial intelligence to help companies make their manufacturing process more streamlined and efficient. Anjali Khemlani joining us now with more on that, as well as the company's CEO. Go ahead,
And
Anj.
founder. Yeah, thanks, Shauna. Joining us now is Quartic AI founder and CEO Rajiv Anand. Rajiv, thank you so much for joining us today. Pleasure to have you with us.
Thanks, Anjali.
I know that we talked really early on in the pandemic about the need that arose from this pandemic of how to do better here in the U.S. with manufacturing, especially in life sciences. We knew that what was happening in China could really impact what the U.S. needs are. And so I wonder, with this talk about the shift that needs to happen, where are we now after all of this time in shifting how life sciences manufacturing is done?
So I think the pandemic, like you said, exposed the rigidity of the supply chain, but how and where we manufacture was a key part of it. So you did see a lot of discussion, a lot of talk, and perhaps a drive towards onshoring or nearshoring. in life sciences manufacturing. But in general, I would say the progress has been slow. But there is another headwind that's coming to this industry brought on by the IRA, the Inflation Reduction Act. So that we see that speeding up, people looking to new methods of manufacture. And I think the fundamental, when you make the shift from, let's say it's from China or India, simply moving a manufacturing factory from China to the US doesn't solve the problem because you have to do it in a different way to be more competitive because you don't have the labor advantages that you had there. So increased level of automation, particularly brought on by AI and machine learning and more, data-driven or what is referred to as Pharma 4.0, becomes a catalyst now to speed up this onshoring. And we're starting to see more adoption, and I think we'll see a lot more progress in 23.
Yeah, that's really interesting because I know, looking at all the different factors that are involved, right? Onshoring is one part of it. Then to your point, the IRA putting a lot of pressure on these companies to reduce costs overall, especially on the R&D side. And then simultaneously, you have the need for the U.S. economy to sort of find a different way to function. We saw that with things like masks and the like, really simple things that can be produced here. Do you think that there's a shift in maybe what the life sciences sector is looking at in terms of, personalized and targeted therapeutics and the relationship that can then come up with smaller footprints for manufacturing, for example?
Right. So, and in fact, all of those factors are driving the need. But I think particularly what the IRA does, all those Part B and Part D drugs, which were, a large part of the portfolio of many of the life sciences manufacturers and a big driver for both revenue and margin. There are really no ways to deal with it. Either you have to start launching generics, which I don't see many companies doing, or you have to now either redesign, repurpose old molecules so that you're not, under the review of IRAs B and D. But more importantly, I think you now have to design and manufacture faster. Particularly on biologics, designing and manufacturing faster, which means perhaps a larger portfolio of drugs, which can be much more profitable to make up for what most manufacturers, unfortunately, have no way of avoiding the revenue and margin loss. So that goes straight to, first it starts with product design. And, if you look at product design, commonly referred to as, PD, even within very large established life sciences manufacturing companies, to be able to run, 4 or 5 or 10 what is called product design campaigns was a matter of pride. Now you have to run 40 or 50, and you simply cannot do that with existing work processes, existing tools that exist. So that's where you have to start first. And that's where we are seeing more adoption, and that's where we are focusing our technology. But so starting in that part makes natural sense because you can design more, but then to go from that early design to manufacture, that the process called the tech transfer,
right,
that also can be done digitally.
Right. So then finally, looking at 2023, what do you think the regulatory side has, in the pocket for this industry? Do you feel like with this adoption that you're seeing, we're going to actually see any issues crop up, or because we know that with tech and health in general, there's always problems and concerns. So what do you see on the books for 23?
So I think that was the bright side of what happened during the pandemic. Regulators have been, rightly or wrongly, notorious for not helping technology adoption move faster. So that was the shining part where you saw regulators become a lot more accepting of new methods of manufacture and new technology. If you look at the Emerging Technologies Task Force of the FDA, recognizing the fact that they need this, bringing someone from the outside, not from the life sciences sector, bringing someone from the outside. So I think that is perhaps going to be one of the most compelling drivers, or something that perhaps was seen as a blocker in the past. So the regulatory environment, of course, will still have to deal with safety and compliance. But if there are technologies, if there are solutions that meet that compliance and allow you to use a new method of manufacture, we have seen the regulators very open and accepting to that.
So it looks like not all hope is lost just yet. Rajiv Anand, the founder of Cortic AI, thank you so much for joining us again.
And Anjali, and thank you for joining us, Anjali Khemlani. Coming up after this, Bitcoin bull Michael Saylor did something he said he wasn't going to do. We're going to give you 3 guesses to ponder and then tell you after the break. Bitcoin trading roughly flat today as one of its biggest supporters, Michael Saylor, is selling some of the cryptocurrency. Our David Hollerith is here to break it down with us. So what's Michael Saylor saying about this latest move that is catching a lot of people a little bit off guard?
Yeah, Jared. So in a filing on Wednesday, submitted Wednesday, MicroStrategy disclosed that they, between November and December 21st, they bought about $42 million worth of Bitcoin. They then sold 12 million of it a day later, and then bought back roughly that amount, plus a few extra Bitcoin. And so what was going on here is it looks to be a tax loss harvesting strategy. So again, the company, the largest corporate holder of Bitcoin, did disclose that they sold Bitcoin, but then immediately bought it back, and it was to offset capital gains taxes. They cited in the disclosure. MicroStrategy also said that between a period of October and December 27th, it raised an incremental $46 million after selling more than 200,018 shares in common stock at $213 per share. Now, the stock is down 76% year to date and closed today at $136. MicroStrategy is still obviously a net buyer of Bitcoin, and they hold a grand total of 132,500 Bitcoins. Also, in other crypto news, the market has been trading pretty sideways for the past couple of days. That's with the exception of Solana's Sol token, which has sold off over 95% since January, and more recently in the last day, it's down more than 10%. This is largely associated with the fact that FTX founder, the disgraced founder, Sam Bankman-Fried, who's now obviously under criminal trial, set to start next week, was a heavy backer of Solana. And so that has been sort of riding in Solana's out of Solana's favor. And we'll continue to watch Sol, which has obviously had a pretty rough year, even for crypto.
Certainly an important story to keep your eye on. David Hollerith, thanks so much. Let's stick with crypto, talk more about the fallout of the FTX bankruptcy and that continuing to play out in court with millions of creditors still searching for funds. We recently spoke with Ken Feinberg, the former administrator of the September 11th Victim Compensation Fund, about FTX creditors and what they can expect going forward. Let's take a listen.
Well, it is complicated and it's rather unique, because in the FTX bankruptcy, there are two questions that are front and center. What is the value of the asset in bankruptcy? Trying to determine the liquidated value of FTX, subject to distribution to creditors, I think is going to be a rather unique challenge. Secondly, you mentioned over 1 million creditors who lost their value in the company. How many of those creditors can demonstrate a loss? Are they going to really come forward, give their name, give their address, designate the amount of the loss, prove that loss in a currency that is very, very opaque? So it's going to be an interesting bankruptcy going forward, both in terms of asset value in the bankruptcy and determining who is an eligible creditor entitled to a check from the bankrupt estate.
It's certainly a complicated and unique case. Ken, just in terms of the transparency factor and the fact that the Bahamian government's involvement in this, does that further complicate what the next several months, potentially years, could look like with this case?
Yes, potentially years. Think about it. The first step before you decide who's an eligible creditor, you have to determine the total value of the asset that is available to the bankruptcy court for purposes of distribution. Well, that sounds like it might be a rather complex challenge, corralling all of those assets wherever they may be and transforming them into real dollars available in the bankruptcy court. And then, of course, it's an international bankruptcy. I mean, you're going to have to figure out who's an eligible creditor. And will the creditors be willing to come forward? Many of them have used cryptocurrency to mask their involvement, keep their identity private, not disclose. Well, if you want to receive now part of the estate, you've got to come forward and with sunlight, lay it on the line. I am a creditor. Here's my crypto number. Here's my loss based on what I invested. I wonder how many of those investors will be willing to come forth now.
And Ken, you have the investors in FTX, you have those who lost the money on the tokens as well, and then you also have some of these celebrity endorsers and trying to understand their relationship as well. How, as you sort of segment these out, how do those paths actually end up playing out?
No, the bankruptcy court will have to decide whether the endorsers are responsible. Very distinguished lawyer in this country, David Boies, has brought a class action lawsuit. He's formidable. He'll marshal his case. He'll lay out the arguments in an effort to hold others liable financially besides FX management and FX investors, FX managers and operational people.
Ken, comparing what we're hearing from FTX to the several cases, many cases that you have worked on in the past, how does it stack up just in terms of the complication factor of it and just in uncharted territory being in the crypto industry and the unfamiliarity that so many people have with that space?
On the one hand, it's much more complicated. Mm-hmm. As I've said, you're trying to separate and finish the puzzle to try and figure out what FX means in terms of dollars and who is an eligible creditor in FTX. On the other hand, I must say, you're talking here about money. You're not talking about 9/11 lives lost. You're not talking about victims killed in the Deepwater Horizon oil rig explosion, or the Boston Marathon bombings where it's death and life-altering physical injury. I have a little bit of difficulty assuming that this complicated, very complicated FTX bankruptcy is as emotional or as wrenching as loss of thousands of lives in 9/11 or the Boston Marathon bombings or other horrible, terrific tragedies where a fund was created, not in bankruptcy, where a fund was created to compensate very angry and very emotionally distraught victims and their families.
Coming up, more Drizzly customers going to be toasting 2023 with bubbly other than champagne. Our next guest explains why when we come back.
We're counting down to New Year's Eve when people all over the world are going to be raising a glass to 2023. Our next guest has an inside look at what people are buying and some of the trends to watch in the new year. We want to bring in Liz Paquette, Drizzly's head of consumer insights, joining us now. Liz, it's great to have you. We know that New Year's is a huge weekend for your industry. So talk to us just about what people are buying this year and how much they're spending.
Absolutely. So the biggest weekend for our industry What we're seeing is, on New Year's Eve, champagne is consistently the top seller across the board. But something interesting happening this year is that in the month of December, when we compare year over year, we're actually seeing that Prosecco is experiencing quite significant growth, about a 20% increase in share year over year, while champagne is seeing a 4% decrease. So while we're still anticipating that champagne is going to likely take that top spot for New Year's Eve, we expect some consumers to be turning to Prosecco and some other alternative sparkling wines this year.
And Liz, when we think about some of the hard spirit alternatives that are available, lining up shots, maybe tequila is there in front of us, what are people clamoring for this holiday season?
Absolutely. So, of course, sparkling wines and wine in general is the go-to for New Year's Eve in particular, but don't count out spirits. Consumers do definitely purchase spirits and spirit accompaniments to make cocktails on this holiday. So we see pretty significant increases in liqueurs, cordials, schnapps, as well as what we're seeing this year is pretty significant growth in tequila in particular. And then I would also expect to see lots of consumers buying up ready to drink cocktails as well for the holiday. So if someone's looking for something a little bit easier and not wanting to mix up those cocktails themselves, that's going to be another option for folks as well.
Liz, what about pricing of alcohol? We talk about inflation all the time, how it's certainly been consumers all over the world have been impacted by this. When it comes to alcohol, how much of a price jump have we seen there this year?
Yeah, so in sparkling wine in particular, we've seen a pretty significant bump in champagne. So if we compare this year to 2020 in particular, the average unit price of 750 milliliter bottles of champagne have increased about 25%. And then since this past year, about 6%. So we are seeing some growth there. And it's a little bit softer on the Prosecco side. And that might be in part why consumers are turning to that as an alternative. And then overall, that's unit prices. We are also seeing shifts in the price points that consumers are shopping across both wine and spirits. And what we're starting to see is a little bit of a Goldilocks effect. We're seeing decreases in share for bottles under $10 and over 50 plus. But then increases in that $20 to $30 range for wines and that $30 to $40 range for spirits.
And Liz, your business, Drizzly, in the business of alcohol delivery. Any trends you can point out to us that may have occurred over the year? I know weather effects recently probably getting people to opt for that home delivery, but just in general, what trends are you noticing?
Sure. So like I mentioned, from a pricing perspective, we're definitely starting to see some shifts there, and we're anticipating that will carry over into the new year. And as one of the leading beverage alcohol e-commerce shops, we're able to see a lot of interesting stuff from a category perspective as well. So I mentioned a couple in particular. Tequila has been a fast grower this year and these past couple of years in particular. And that is something we anticipate in 2023 as well to continue. Ready to drink cocktails are experiencing a moment just like hard seltzer did a couple of years ago. And then additionally, the non-alcohol category is really starting to accelerate on the platform as well. While it's still a smaller percentage, we're anticipating that this will be a trend that's here to stay for quite some time. And that's across spirits, beer, and wine.
Yeah, Liz, it's interesting. We've been talking a lot about the rise of non-alcoholic drinks, how that is more and more popular, especially with younger generations. Is that consistent with what you're seeing on your platform in terms of demographics? And I guess how big of a jump have you seen there in sales of the non-alcoholic drinks this year?
Yeah, absolutely. So we ran a recent study with our consumer base, and we're finding that millennials and Gen Zers are the ones who are leading trial of non-alcoholic spirits, wine and beer. And we're seeing increases across the board, across beer, across wine and spirits. And in particular, I think over the past 2 years in wine in particular, it's been about a 500% increase in share of sales on the platform. So, this category is really, just getting started, but the sky's kind of the limit there.
And you mentioned hard seltzer a minute ago. Want to ask you about the ready-to-drink category in general. Yes. What are we seeing there?
Yeah, so one of the categories in particular that's leading a big increase in RTDs is consistent with what we're seeing overall with spirits, and that's tequila-based ready-to-drink cocktails. So that's the fastest growing subcategory within RTDs, but we're definitely seeing growth across the board. The number of SKUs available on the platform has increased. Something to the effect of 70% of our retail partners have said that ready-to-drink cocktails have dramatically changed their stocking strategy in store and will do so permanently. So we're anticipating that we'll see a maturation of this category, and that consumers will continue to try and discover new brands, but that again, here we're expecting continued growth.
Liz, give us some tips on people out there who maybe haven't decided what they're going to be drinking on New Year's Eve, if they do in fact decide to partake, because my favorite bottle of wine is a Pinot Noir. It costs like $12 or $13. I'm certainly not the person to be answering this, but what would you say in terms of what you are recommending this year?
Sure, absolutely. So categories wise, I would recommend some of the mainstays. So a good bubbly, popping that open at midnight is always a fun thing to do. And if you're someone who does typically grab a bottle of champagne, maybe this is a year to try an alternative like a Prosecco, like a Cava, which is made in a similar method to what champagne is made in. So that's one option, trying some fun tequila cocktails, RTDs. What I'd say is, if you're someone who is, having some people over, hosting a little bit of something, or even at home with, a significant other, to me, New Year's Eve is a great time for trial because you've got some folks around you. So why not grab a little bit of everything and see what fits your mood that night?
You got to branch out. You got to do it responsibly, though. Liz Paquette, always great to have you over Drizzly. Thanks so much for joining us. I think we're all thirsty and ready for a drink at this point. Well, that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a great night.